Welcome back to our channel. We are in CFA Program Exam Preparation Series. This is study session number 5, reading number 17. Today's topic is evaluating quality of financial reports. 2. Quality of financial reports. 2.1 Conceptual framework for assessing the quality of financial reports. View the diagram for the relationship between financial reporting quality and earning quality. The presence of high-quality financial reporting is a necessary condition for evaluating results quality. High-quality earnings provide an adequate level of return on investment and are sustainable. A company that provides GAAP-compliant, decision-useful information about low-quality earnings would appear lower on the quality spectrum. Problem with biased accounting choices impedes an investor's ability to assess a company's past performance correctly. Aggressive, conservative, Dorian companies reported performance in the current period and may report performance in a later period. 2.2 Potential problems that affect the quality of financial reports. 2.2.1 Reported amounts and timing of recognition. Aggressive, premature and fictitious revenue, recognition, where overstated profit, where overstated equity, where usually accounts receivable are also overstated. Conservative revenue recognition, where understated income, equity and understated assets, omission and delayed recognition of expense, one understated expense, one overstated income, equity and assets, one understated liabilities. Contingent liabilities understatement, overstated equity resulting from understated expenses, overstated income, and overstated other comprehensive income. Overstatement, understatement of financial assets, liabilities, reported at fair value is associated with overstated equity resulting from overstated unrealized gains or understated unrealized losses. CFO may defer payables, inventory purchases, and other operation-related expenditures, or accelerate payments from customers. 2.2.2 Classification Exhibit 4 Accounting warning signs, potential issues, possible actions, choices. Warning signs, view the title-wise explanation. 2.2.3 Quality Issues and Mergers and Acquisitions. Mergers and acquisitions provide opportunities and motivations to manage financial results. Acquisitions can provide a one-time boost to CFO that may or may not be sustainable. Investors cannot reliably assess whether or not the acquirer's CF problems are worsening, as no required post-acquisition, with or without acquisition, disclosures. Acquisitions complicate a company's financial statements, and this can conceal previous accounting misstatements. Acquisitions also provide opportunities that affect the initial consolidated balance sheet and income statement in the future. The acquirer may understate the value of amortizable intangibles when recording an acquisition. 2.2.4 Financial reporting that diverges from economic reality despite compliance with accounting rules. Financial reporting must also reflect economic reality. An analyst should adjust the reported information to better reflect his or her view of economic reality. Analysts must evaluate whether restructuring impairment charges occur regularly and would be part of normalized earnings or not. Revisions to the remaining economic lives of assets may lead an analyst to question whether an earlier change in the estimate would have been more appropriate. Sudden reverses and allowances could call into question whether the prior estimates resulted in overstatement of the prior period's earnings. 3. Evaluating the quality of financial reports. 3.1 General steps to evaluate the quality of financial reports. The following are the same steps an analyst can choose to evaluate the quality of financial reports. Develop an understanding of the company and its industry. Learn about management. Identify significant accounting areas. Make time series and cross-sectional financial and ratio analysis. Check the warning signs of possible issues. Check exposure to geographic regions or product segments in multinational firms. Use quantitative tools to assess the likelihood of misreporting. 3.2 Quantitative tools to assess the likelihood of misreporting. 3.2.1 Beneish model, find financial calculations. DSR, Days Sales Receivable in Relationship, BW Receivable, and sales could indicate inappropriate revenue recognition. AQI implies Asset Quality Index in percent of assets other than PPE and CA could indicate excessive expenditure capitalization. SGI stands for Sales Growth Index. DPI implies Depreciation Index Depreciation Rate could indicate understated depreciation as a means of manipulating earnings. SGI, Selling, General and Administrative Expenses. Index in SGA expense suggests admin and marketing efficiency. Accruals. Higher accruals can indicate earnings manipulation. Levi, a leverage index. Increasing leverage could predispose companies to manipulate earnings. 3.2.2 Other quantitative models. Researchers have identified other variables for accounting manipulations. Some variables are order to change, market to book value, etc. 3.2.3 Limitations of quantitative models. Financial models based on accounting numbers are only capable of establishing an association between variables. Manipulators are just as aware as analysts of the power of quantitative models. Fourth, earnings, quality. 4.1 Indicators of earnings quality. High-quality earnings generally represent returns equal to or in excess of the company's cost of capital and are sustainable. 4.1.1 Recurring earnings. Earnings that are expected to recur in the future. Discontinued and other non-recurring items are separated. Determination of whether an item is non-recurring involves judgment. 4.1.2 Earnings persistence and related measures of accruals. Earning persistence sees sustainability of earnings excluding items that are non-recurring and persistence of growth in those earnings. Components of earning, cash components. Accrual components. The cash component is more persistent than the accrual component. If a firm reports positive net income but negative operating CFs, the earnings quality is questionable. 4.1.3. Mean reversion in earnings. Mean reversion in earnings. Extreme earnings, high or low, tend to revert to normal levels over time. Mean reversion is a natural attribute of competitive markets. In constructing analyst forecasts of future earnings, analysts need to develop a realistic CF model and realistic estimates of accruals. 4.1.4 Beating benchmarks. A company that consistently reports earnings that exactly meet or nearly beat benchmarks can raise questions about earnings quality. 4.1.5 External indicators of poor quality earnings. These indicators include enforcement actions by regulators, restatement of financials. These indicators are relatively less useful to an analyst. 4.2 Evaluating the earnings quality of a company. Cases. 4.2.1 Revenue recognition. Case Sunbeam Corporation. 4.2.2 Revenue recognition case MicroStrategy Inc. 4.2.3 Cost capitalization case WorldCom Corporations. 4.3 Bankruptcy prediction models. 4.3.1 Altman model. Models use ratio analysis to identify likely failures. It incorporates numerous ratios into a single mode. The model overcomes the limitation of viewing ratios independently. Ratios in the model reflect liquidity, profitability, leverage, and activity. Altman's Z-score is calculated as View the calculations. 4.3.2 Developments in bankruptcy prediction models. Shortcomings in the Altman model. Single period, static nature, meniscus hazard model addressed this shortcoming by incorporating all available years' data. It incorporates the going concern assumption rather than one that might be a failing solution, i.e. use a market-based bankruptcy prediction model. 5. Cash flow quality. 5.1. Indicators of cash flow quality. Operating CFs, a CF component that is generally most important for assessing a company's performance and valuing its securities. High-quality CF is a desirable trail and enhances the company's value. Corporate life cycle and industry profile affect CF and must be considered when analyzing CFs. Reported CFs should be relevant and faithfully represent the economic reality of the company's activities. A large difference between earnings and operating CF can be an indication of earnings manipulation. Timing and classification of CF are major issues in CF reporting. 5.2 Evaluating cash flow quality. Operating CFs are less subject to manipulation than earnings and are thus used to identify areas of potential earnings manipulation. A shift in CF classification does not change the total amount of CF, but affects investors' expectations regarding CFs. IFRS permits the classification of interest paid as operating or as financing and interest received, and dividend received as operating or investing. US GAAP required interest paid received and dividend received as operating CF. Analysts must have to make adjustments when comparing CFs under US GAAP and IFRS. 6. Balance sheet quality. High financial reporting quality of the balance sheet, BS, is indicated by completeness, unbiased measurement, and clear presentation. High financial results quality, earnings indicated by adequate liquidity, optimal amount of leverage, and successful asset allocation. Completeness implies a significant amount of off-balance sheet obligations could be a concern for an analyst. Unbiased measurement is particularly important for assets and liabilities for which valuation is subjective. Clear presentation, ASI. It includes specification of many aspects of what appears on the BS. 7. Sources of information about risk. 7.1. Limited usefulness of auditor's opinion as a source of information about risk. An auditor's opinion is unlikely to be an analyst's first source of information about a company's risk. A change in auditor, especially multiple changes in the auditor, can signal possible reporting problems. 7.2 Risk-related disclosures in the notes. Notes to the financial statements typically contain information that is useful in understanding a company's risk. Disclosures also emphasize the uncertain timing and amount. Financial instrument disclosure provides information about credit, liquidity, and market risk. 7.3 Management Commentary, Management Discussion and Analysis, or MD&A. Purpose of management commentary: to help users of financial statements understand the company's risk exposures, approach to managing risks and risk management effectiveness. 5 elements that should be contained in the commentary: nature of the business, objectives and strategies, resources, risks and relationships, results and prospects, performance measures and indicators. 7.5 Financial press as a source of information about risk. The financial press can be a useful source of risk information when a reporter unveils an issue that has not previously been recognized. The source of any particular news article is important. Further investigation of the initial idea from a news article is essential. 7.4 Other required disclosures. Other required disclosures that are specific to an event can provide important information relevant to assessing risk. Examples include capital raising, management changes, non-timely filing of financial reports, etc. That is all for today. Thank you, everyone. We hope this information is useful to you. If you are willing to continue with these lessons, subscribe to the channel to find more videos. Quickly like and share the videos. You can also ask the question in the comments. We will be happy to answer. Here is some glossary for you to understand the terms used in lectures.